And we are live. Hi, everyone. Sorry, we're a little bit late today. A little bit of a kerfuffle of a morning, if you want to call it that. I'm Allie Wyatt. Super excited to be here today with Sapna Shah. We have so many things we're talking about from an angel investor perspective, one of my absolute favorite topics. But as a quick reminder, I'm Allie Wyatt, co founder and CEO of Female Founder Collective and the 10th house, which is our private membership community, as well as the North, which is our marketplace of expert advisors who can help guide you through your various pain points as a founder. We just closed out our consumer cohort. So this is actually particularly relevant because Sapna has just an extraordinary wealth of consumer background, which we'll get a little bit into. But otherwise, we are actually working towards our women's health cohort next, which I couldn't be more excited about. It's something I'm so passionate about personally, having faced my own health challenges in the past. So can't wait for that. So stay tuned. And I'm going to, without further ado, begin to introduce Sapna and her incredible background of extraordinary experience. She is an angel investor, a retail expert, and a 3-time entrepreneur. And through Red Giraffe Advisors, she makes pre-seed investments in the future of retail and consumer, which includes retail tech, e-commerce, marketplace, and consumer startups. She is also the founder of the Retail X series, which is an ecosystem for retail consumer startups featuring webinars, events, a podcast, a Slack community, and resources for early stage founders. And previously, she co-founded independent equity research firm Retail Eye Partners and menswear e-commerce startup Mind the Chap. She's also held executive strategy roles at Linens and Things and Ann Taylor and began her career in retail at Gap Inc. And previous to her career in retail, Sapna worked in investment banking at Punk, Ziegel, and Knoll, and in credit at Morgan Stanley. And she is one of our extraordinary North advisors. So if you do want to book a one-on-one with her to sort of explore some of the concepts we talk about deeper, you can check out the comments section for a direct link. But without further ado, I'm going to jump in because we've had a lot of also questions that came in ahead of time, largely around what and how sort of angel investors think. So I wanted to ask the question because I think a lot of people don't know the difference, but between angel investors and venture capital investors, what is sort of the key difference in your mind?
Yeah, sure. And first, let me just say thanks for having me. I'm so excited to be here. And hopefully, I can give you all some information that is helpful in your own fundraising process. But to answer your question, I always say that angel investors are investing their own money, not other people's money. And that goes downstream kind of into every step of the process. So, VC investors are raising from other institutions, high net worth individuals, that they call limited partners, and they have to report back to those limited partners. And because of that, they have a lot of structure. They have investment meetings. If you're pitching to a VC, it may take a long time as they go through their diligence process and check all their boxes. And research, your company and the competition, and then create an investment memo. And that's a process. Most angels don't go through that kind of rigorous or formal of a process. While I would say I do due diligence and I want to know what's going on at a startup that I'm investing in, it can be a lot quicker. I can make the decision, within days. It does not usually take weeks or months. And I don't have anybody to report to but myself. So it's my money. I can kind of choose how I invest it. I'm a team of one. Most angels are a team of one. And that makes the process for founders a lot easier with angels. I have not done this, but I've heard of my portfolio founders getting a check in the first meeting that they've had with an angel, and that would never happen with a VC unless you were like a 3-time exited famous founder, right?
Yeah.
So
That is a great point. And I think it's so important, though, that founders understand the process and sort of all the decision makers that are involved when it comes to venture investors versus angel investors, and also the sort of the process with which they need to manage the money, and they are a fiduciary of someone else's money, which is a whole other sort of level of responsibility. Um, as an angel and as a founder seeking an angel, what are the differences in expectations that founders should have for angel investors versus VCs? And when does it make sense to partner with an angel over a VC, for example?
Sure. I think I'll answer the second one first, which is that the earlier stage you are, the more likely an angel is, or a set of angels is the right fit for you. I think the later stage you go, the more you're going to want truly institutional capital that can write big enough checks to really scale your business. I think the expectation founders should have is that angels' check sizes vary dramatically and will vary from one investment to another by the same angel. That's not necessarily true of me. I write a 50K first check pretty much always. I think I've made one exception to that. But most angels will, maybe if they feel really comfortable, they might invest 10K here, a 5K there, a 25K here. So it's not predictable. And I think as founders, you have to ask more questions of the angel of, A, are you writing checks? Is this the kind of business you write a check into? And what is your average check size for something like this? So I think you can find a lot of that information about VCs, but that information for angels generally tends to be really sparse. Many don't have their own websites or might put something on LinkedIn, but it might be old. So kind of knowing those questions to ask up front, and then understanding their process, because VCs have a very strict process and angels don't necessarily have the same kind of process, and it varies from one to another. I'm a great example of this, that I think I'm one of the rare angels who does deep dives into financial models, because I was an investment banker and I like financial models. But not all angels will do that. They might be much more concerned. One might be more concerned with your TAM, your total addressable market. Another might be much more concerned about your backstory and why this is kind of why is their founder market fit, for example, or founder product fit. So I think it really varies. And I think each of those meetings can go completely differently depending on the angel.
How do you find those places, Sapna, where there's somebody that's writing bigger than a 5K check? Are there any sort of areas that you found? Because I often get that question from founders, and I suppose there's angel groups, right? And I think there's a lot of SPVs that are happening. But is there a place that you tend to direct people to sort of know, okay, these are going to be bigger angel checks than 5K?
I think it's hard to find, right? So I think if it is an angel who has listed all their investments on LinkedIn, which really happens so rarely, but if they have done that, or they have their own website with like a broad portfolio, I think I have maybe 25 companies on my portfolio page. That is probably a sign that some bigger checks are being written here, or at least they're more often being written. And so there's maybe more of a standard amount, and maybe it's not 50K, but maybe it's 10, right? So I think you have to kind of you almost have to find kind of what are the data, what are the facts kind of adjacent to what I'm looking for. And then I think, honestly, the network of founders can be really helpful here. Your founder friends who have raised from angels know what size check they got from that angel, right? And that can be some good back channeling to do if you're researching angels, to say, okay, what angels do I know who invested in my founder friends' companies, and what sort of check sizes did they write? But there's no database. I mean, there's no easy way to figure any of this out.
It's so true. And I thought maybe she has a secret, but
I wish.
I do find it's sort of asking other founder friends. That's why it's really crucial to have a founder network. You guys, the North is a great place to find angels, because I think people will invest their accredited angels that maybe they haven't made a lot of investments in the past, but if you are in their zone of expertise or their industry, then they're going to be a lot more likely to jump in and to want to invest, and also be able to connect you with other people that would be able to invest as well. I want to jump to another question that I've gotten from a lot of founders that I sort of had for later on, but I think it's a nice adjacent question to this, and that's, do you need a VC anchor for a round? And what is a good sort of way of determining whether or not you do, or could you have all angels lead a round? And what do you think are sort of the positives and negatives to doing that?
I love this question. And I get this question all the time.
Right?
So I have multiple thoughts on this, but what I'll say is if you're doing an early round, I tend to invest pre-seed. So if you're doing a friends and family or a pre-seed round, you absolutely can make it a quote unquote party round. You don't have to have a lead. You don't have to have a VC. We all know the stats on VCs investing in women-founded businesses. They're not good. So like instead of, hitting your head against the wall for those super early small rounds where they might not be big enough for a VC anyway, having an angel round is absolutely fine. I think when you get to the later stages, seed and beyond, if you don't have a VC in your round, or sometimes multiple, a lead and then others, you end up with lots of small checks. It is doable, but you may not enjoy that process, and then you will not enjoy managing all those investors over time who are now on your cap table, come hell or high water, like for as long as you have this company, they're on your cap table. It can just be a mess, and it can be too many investors on your cap table for you to adequately, you send out an update and suddenly you get like 100 replies. Like that makes you not want to send out company updates. And so, that you can go down this spiral of like really not enjoying your investor interactions. So I think for that reason, and then the second reason is if you don't have those that start getting some institutionals in, if you're on that path of like a typical SaaS or software company where you're really going to be raising multiple rounds, not having a VC by seed stage is going to make it that much harder to ever raise future rounds. But if you're on a path to just get to profitability, you're going to make a lot of cash. You're never going to really want to raise another round. And that is a perfectly valid strategy, by the way, even though, I think that's not what you read about in the news. Then maybe you don't need a VC. Maybe you just need to raise a round or two of funding. You get to profitability. You have a great business. You continue to scale it with the profits from your business. And guess what? You never need to raise again. And then it's not even an issue. So I think it comes down to sort of personal choice and kind of what kind of company you want to build and what kind of path you're on. But if you are on that path that you think you're going to get to raising Series A and beyond, at some point you need some VC dollars in there before that.
And do you think that there's a size, Sapna, that like means it's going to become unwieldy? I have seen certain companies and founders raise $9 million from pure angels, which is like one of the most insane feats I think I've ever heard of, but because that is a lot of checks. But would you say like, if you're doing $500,000, that could be an angel round, but if you're north of 2 million or 3 million, then you're almost definitely going to have a VC in there that is going to anchor your round.
Yeah, I think you're kind of hitting the nail on the head. Like the bigger the round, the more you're going to need an anchor. I think I've seen a lot of rounds at around $1 million, $1.2 million that don't really have a VC in them. And that seems to work fine, especially if you can get an angel that writes like at least one angel who maybe isn't really a lead, but kind of acts as a lead, is experienced, knows how to explain the terms to you, because usually as founders, you don't understand all the terms that are, in the documents, and you guys can set a valuation together as kind of a partnership.
Yeah.
And that person maybe puts in 150, right? And that can kind of be your lead instead of a VC. So I've seen that work really well. I think the 9 million story, that seems crazy to me. I would never do that.
Right.
Never, never, never. But I have seen something similar with, I think it was a 5 million round, but one of the angels put in 3 million. I mean, that is so rare. But if that listen, if that happens, then sure, go with that. Do that.
Great, right?
Yeah, do that.
In terms of you talked about terms for a second, and I think that's a really important point because a lot of times the lead investor, i.e. a VC, will serve really as the party dictating a lot of those terms that you're negotiating with. When you're doing a purely angel round, what are your recommendations for founders as they're thinking about how do I create my term sheet that's going to be most amenable to most angels?
Yeah, that's a great question. And I think the answer here is be as standard as possible. Do not change anything in the documents. Really, the only thing you should be changing is if it's convertible note, it should be the interest rate and the cap. If it's a safe, it's the cap, how much you're raising. Like it, literally just fill in the blanks and do not change anything. I think what happens is sometimes, and I don't like to speak badly about other angels, but I think sometimes angels that maybe don't have as much experience will ask for certain additional liquidation preferences or things that don't make sense in early rounds that are, you end up spending a lot of lawyer time negotiating where the company is too early to really spend that kind of money on lawyers to kind of do your first round. So, I always say both for kind of angel investments at that early level and even advisory agreements, just stick to everything that's standard and available on, I have them on my website. I've set a standard documents. The YC safe is a very standard document. Pick something standard and go with it.
Yeah. And I will say, as an angel, I've asked for particular things, but I think what's important is you share upfront. Like, in order for me to, like, I won't invest in a round if there aren't certain clauses and terms in those documents, just because I've been burned so badly on those in the past. And so I think just having that transparent conversation, if you are an angel upfront, of like, these are like my deal breakers, so the founder can decide if they do in fact want you in still, which a lot of times they won't.
Yeah.
And that's fine for both parties.
Yeah. I mean, I agree with you. I always ask for pro rata rights because what is the point of investing in this round if I'm not going to get to invest in the next round when things are really going well?
Yeah.
And that usually, that those aren't in safes, right? And they're usually in priced rounds. And so you kind of have to add it into like a convertible note or a safe document. And that can be something that you want to negotiate. I think what I'm more talking about is things that are very where the angel can sometimes be putting their fingers more into the operations of the business, like approving hiring, things like that. That starts to move into this whole other place, like they're your co-founder, and unless you want them to be your co-founder, you don't want that.
Right. Oh, that sounds so icky as a founder too. So in terms of the process for evaluating from your perspective, Sapna, and for angels who are contemplating, I want to start investing in companies, how do I even think about diligencing them? And also for founders who are like, how do you make decisions? How do you evaluate a company? Can you share a little bit about your framework?
Sure. So I think everyone's is different. Mine starts with the founder. I always start with the founder. I am looking at founder market fit. Why are you starting this business? Why you versus somebody else? What's kind of that unique insight you have into this market or this product? And that's kind of what I spend the early part of my time with a founder talking about. And my framework is really simple. It's really 4 things. So that was the first thing. Second is I want to understand what is unique about your product versus the competition. And yes, there is always competition. I think one of my big pet peeves is founders who say there's no competition in the space, because there is, even if it's something that's like an Excel spreadsheet to do the thing, or to like it's a notebook and a piece of paper, like that's still competition. So I want to know kind of versus the competition, kind of where the founder sees their product and company sitting, and how they will win. The third thing I look at, and this one is so critical, but is either, whether if you're consumer facing company, kind of what's your customer acquisition strategy? And if you're like B2B, are you, what's your kind of sales process, or what's your, how are you onboarding customers? How are you going to get them? Too often, founders put a slide in their deck that says, I will do paid social, we'll do SEO, I will have influencers, and we'll do pop-ups. And that's a classic consumer brand slide deck page. Those are activities, not a strategy. And they're the same thing that everyone does. And of course you will do those things, but like, what's that unique insight that you had about your product that you can get this product into customers' hands in a way that's not going to require millions and millions of dollars of spending on paid social? And if you're more of a B2B, are you going to cold email? Like, that cannot only be the only strategy here. What's your strategy for getting small or medium or large enterprises on board? How do you deal with those sales cycles, which can be very long in sort of the retail tech and fashion tech space? So that is a bucket, I think, where it can. That's where I kind of spend the most time and do the most work and try to figure out if there is something here that's really unique and worth investing in, where it will not take millions of dollars to scale the company. And then my last piece, which I alluded to earlier, is I like financial models. And so I spent time talking through a financial model with a founder and understanding what their assumptions are and how they relate to their business plan, right? So I think of financial models as just a numerical representation of your business plan. And so if you are planning to grow your customer base, for example, are you just, in your financial model, are you just assuming they sort of show up and it's 5% a month or 20% a month, you're just increasing number of customers? Or are you really saying, like, these are the marketing activities and things that I'm going to do that result in top line growth? Obviously, the second thing is better than the first in a model. And so I really want to know how you think about your business from a like numerical perspective. So those are kind of the four things I always look at. And then, of course, if there's something unique about the company that has a regulatory, perspective or something like that, of course, I'll add those things on. But this is really the core of how I evaluate companies.
And Sapna, when you think about financials, because I want to dig into that for a second, because I think there's a lot of questions around, what do I actually put in a deck, right? And what is appropriate to show a potential investor, because the reality is these businesses are brand new, right? So there's no historicals to go off of in most of the cases for a pre-seed business. How far out should they be projecting their financials? And like, how precise can they be about the assumptions? Is it more you just want to see how they're strategically thinking and planning for those things? Can you speak a little bit to sort of your expectations there on the specifics around numbers?
Yeah. So I think the only thing we know about startup financial models is that they are wrong. They are 100% wrong. There is nothing that's going to be right about them.
Right.
So what I'm looking for is, like, the next year, the first year, the go-to-market year, month by month, kind of how you've thought through the costs and how those costs translate into revenue that you're earning.
Yeah.
And then I want to see kind of maybe another 2 years of growth and kind of getting a sense of how big you think this business can be. A lot of times founders will sort of sandbag their numbers and say, like, we'll do 500,000 in the first year, 700 in the second year, 900 in the third year. And I'm like, that's not the kind of growth that's going to get a VC excited about it. And also, are you just being way too conservative? Like, if you've really got this great product that's so unique that there's very little competition for, you should be able to build this business a lot bigger, a lot faster, right? So those are the kinds of questions I'm asking. I'm not asking, why does cell B32 have a 12 in it, right? Like, that's not the level of analysis. It's more of, okay, you're assuming that 90% of your growth is coming from paid social. and you said you were doing this influencer strategy and this pop-up strategy in your deck, but you don't even have that in the financials. Like, when are you doing those things, and how will they result in more sales? So it's really the underlying assumptions and trying to get to an understanding of how quickly can this business grow, again, without like breaking the bank and running out of money. And then I think the last part of that is, do you in this model either get to profitability or get to a metric when you run out of cash? Do you have a metric at that point that can allow you to raise more?
Right.
I think a lot of founders say, I have 12 months of runway with this raise. Well, that's great, but what metric do you get to in 12 months? Because if that metric isn't enough, it's not big enough to get your next round, and get investors invested in the next, interested in your next round. A time metric is irrelevant. It's sort of like, I'm going to get to 1 million in sales and this many customers, right? Like, that's a metric I'm looking for before you run out of cash. So it's sort of those two things.
And I think on that point, a lot of people ask about benchmarks. And I think for VCs, it's a little bit more clear, right, on what they're looking for. Have you found with angels, or even just you in particular, do you have certain benchmarks that you have in your head for consumer businesses or SaaS businesses, and like milestones that founders can kind of orient themselves to when they're going out and they're speaking to a VC and they're putting together those models?
I mean, a little bit yes and a little bit no. More that if you know that you're going to want to ultimately raise a seed or Series A, you want to look at the VC benchmarks and you want to say, here we are at pre-seed. How do I get to those
Yeah.
levels? And they're different depending on different industry and kind of company and whatever. So, that there's a lot of, I think for founders, it's a lot of trying to figure out, in my space, what are the benchmarks for my type of company? And then working backwards to say, okay, how do we get there from pre-seed? I do think, though, that there are other ways to think about those kind of like traction and benchmark numbers early on. A lot of times at pre-seed, you don't have anything yet. You don't have revenue. You might not have a product, but you might have pre-orders, you might have wait lists, you might have Instagram engagement, you might have, if you're B2B, you might have an unpaid pilot going on of a company that's willing to test your product, right? So there's other ways to show early benchmarks, but then how do those translate into those later benchmarks that you're going to need to have if you want to continue raising seed, Series A, and beyond?
And I love how you mention those don't need to be sales, right? It can be pre-orders, it can be sign up lists, it can also be your email lists, right? So, and then an expected conversion off of that email list that you've created. I think that that's really important note. And a lot of founders get sort of tripped up in that. They're like, well, I don't have sales. So like, how do I show traction when I don't have a product out in the market yet?
Right. And sometimes it's just engagement. How much engagement do you have
Yeah.
on your Instagram that people are saying, I can't wait for this to come out? Do you have any metrics that show a readiness or willingness to pay, right? And that's a lot of times those pre-orders are putting a credit card down. If somebody's putting a credit card down, that's as good as a sale.
Yeah. Yeah. No, absolutely. I think you invested in the wing too, or no?
Yes.
Yeah. And that was their traction, right? As they had shown, we have X number of customers that already put a credit card down, which shows that we're actually going to be at profitability upon opening.
Right.
So as an investor, there's almost nothing better than being able to show that. So I think that's probably why they also got so many great investors in on their round. When you are when you're working, once you've invested, right? Can you speak a little bit to how founders can expect to work with angels, or how can they best leverage them? And then conversely, what should angels expect? Say they did write a 50K check, say they wrote a 100K check. Like, what could their expectations be? How do they help the founder to sort of manage them as well and utilize them?
Yeah, great question. So I think on the founder side, and I'll speak for myself here because I think there's so many different kinds of angels and with all different kinds of backgrounds. But I invest in an area that I have worked in since 1997. So if I have any expertise in my life, it is in retail and consumer. And so that area tends to be where I help a lot of my portfolio founders quite a bit, because I can open my Rolodex. I guess we don't call them Rolodex anymore. I can open my phone and make connections, right? I can introduce people to potential clients or to partnership opportunities. I actually many times I'm connecting my own portfolio founders together, because somebody has a problem, they haven't dealt with this on a subscription basis before, and they want to figure out how to do subscription. Okay, well, here's another portfolio founder of mine who has a subscription business, and connecting them so that they can learn from each other. And then I think a lot of times in those, I can be the first check-in. And so for a solo founder, if I'm the first check-in, they don't really have a co-founder, they don't have a team yet. I can be everything from therapist to having a second set of eyes on a candidate, and interview candidates early on. I can help with their financial models, see previous discussion. And then I think what most angels hopefully should be able to do is help fundraising in the next round, or introducing to other angels or VCs for the current round. So, or both. So I think it can be, and it can vary over time, as companies get to sort of seed and Series A. I think I am less involved with them. There's more people around the table for the stage of company, the stage of business that they're at. And maybe I only come in now and again. But I think the question founders should ask their angels on their cap table is kind of, what are the ways you would like to help me, or that you would be able to help me? And here are some asks I might have that I want to make, because I think this might be relevant to you, or it might not be. I have one founder who actually does an unbelievable job of this with sales. She basically says, go to your LinkedIn, put in these 5 words or whatever description. Anybody who comes up as your first degree connection that fits those 5 words, I want an intro to. I'm like, that's so easy. I love it. Like, yes, any day of the week. And then she'll even give the intro like format. So it's like you have so little work to do, and yet you're really helping out because you're building the top of the funnel for sales. So, it really just depends on kind of what help founders are looking for. But certainly my experience is that I want to do as much as possible.
And I've actually seen founders in the past send out a list of asks and needs and just distribute it to their list of angels. And that is, like you said, so helpful. And then when they have a form, like you said, where it's just an easy plug and play, I can send this out to my contacts. Like, I think the other thing I would say is, to your point, make it as easy as possible for the angel investor to do work for you, because otherwise I do think it can encroach on, is this like angel investor work, or is this like something you should be paying them for?
Right.
Which I think sometimes it toes the line. It's also hard to know as a founder how much bandwidth your angel has to be able to support in certain ways. But I think always making it as easy as possible for them to help you, and also being as specific as possible, as you mentioned, is going to yield so many great results.
And Allie, you mentioned an amazing thing, which founders should do too. It's not just the investors in your company. It's all the people you have on that stakeholder email that you send out maybe once a quarter, maybe twice a year, maybe to angels who've turned you down or VCs have turned you down. You can still make those asks to them. People are happy to help if they can, and especially if they feel bad that they didn't invest, right? There's some lingering guilt of like, oh, I messed up this one, or
maybe they put it into your next round. They saw that you're doing great, and now they're ready. And yeah,
exactly.
Great point. So let's talk about your evaluation of the founder, because I think so many angels and so many VC investors, even at the early stage, say that is the number one thing. So are there patterns that you've seen over time on the founders that are successful? And can you share some of those character traits? And then on the flip side, are there sort of red flags that you see in founders or in their process where you're like, this is not going to be a good investment, or investments you've made and then you've gone, I learned that these traits in a founder are not great? So maybe they weren't red flags initially, but
We could talk about this for hours.
I
Yeah, so I think what I've found, and I've been doing this 10 years now, I have found that founders that are intellectually curious continue to want to learn about their industry, even a broader set of interests, their company, learn about kind of what's happening in the world, and are very open to that kind of input, whether that's feedback from an investor or a partner or a client or a customer, who are willing to sort of take that in and make it part of their process. Um, that's a trait that I think is very hard to teach, but when that founder has it, I think you see it. Like they're excited to riff on new ideas. They tend to be very customer driven. So really trying to, optimize the product and the company for the customer's needs, sort of relentlessly, and kind of have that grit and resilience, because honestly, these companies do not exit for really long times. And you are, I mean, I've been a founder. It's really hard. The day to day is so hard. So like having that grit and resilience and not wanting to just give up at the first kind of roadblock, I think those are some critical things that I found that have been really helpful in gauging success. But on the flip side of that, you can be like sort of, if you exaggerate some of those things, they can be really bad, right? So reacting to every customer comment and changing your product 8 million times because, like, there's a couple of people who want something one way and not really looking at the bigger picture. So, kind of maybe getting too stuck in the weeds can be a problem. And, I would say that I think sometimes founders love their product like maybe too much, right? It's my baby, don't tell me my baby is ugly, right? And that can stagnate, because that can work in the early days, and then as your product needs more bells and whistles, or you're talking to different demographics and you don't change enough, and you kind of get stuck with this kind of original vision, that can be sort of challenging. That one's actually really hard to screen for, I think. But I do think that as long as you can screen for I take in all feedback, I see what's out there in the world, I can continue to improve on my product and on my company. I think that's that kind of attribute it's just, I think, can lead to success really well.
I love that. Self-aware leaders don't get too stuck in the weeds. Those are really hard. But those are all really great points, and it's interesting. It's like just knowing what advice to listen to, and when to sort of listen to your gut and your own sort of internal rudder. Um, there's so many great questions from our community that have joined in. One of the sort of overriding themes that they do ask about is that right now, consumer funding in particular in retail is really tough to get VC. So where do you see angel investors coming in on this, and what other sort of funding solutions do you think are out there to help founders sort of get through this really tough period, which is that there's not a lot of VCs focused on consumer?
Yeah, I think we're seeing a correction in what has happened in VC. And I think when there was a time of cheap paid social back in the olden days, it made sense to treat consumer brands like software companies, because it felt like they were going to be infinitely scalable because it was so easy and cheap to find new customers. Obviously, that has changed. And that has really thrown a monkey wrench into kind of the way VCs think about the category. And we don't need to get into the economics here, but VCs really need to have massive exits for their model to work. Angels don't, because they are not, as we previously said, raising from other people. There's angels tend to have kind of people like me, like really focused on one industry or a sector where I have expertise. And a great outcome for me does not have to be a billion plus outcome. So, I think angels are a great place to go for consumer, especially in early stages like pre-seed and seed. But I think what we've forgotten back in the like 90s, if you were going to start an apparel business or a cereal bar business or a kombucha drink business, you used kind of the tools that existed, and VC did not invest in those companies back then. And so you did things like pre-orders and wait lists, and you did wholesale distribution, and you used debt very strategically. So whether that's inventory financing, accounts receivable financing, for example, if you have a lot of mom and pop shops that you're selling to and they don't pay very quickly, you can use an accounts receivable firm that actually deals with that, but also gives you the money up front so you can manage your cash flow. Working capital lines. Now we have crowdfunding, which I think, crowdfunding is great for consumer products. People want to support, particularly products started by women founders. So I think there are a lot more options now, and there's not one single answer. It's really exploring all of these options and looking at what's right for your business. And by the way, if you're in a lot of consumer businesses, I'm going to say this and it's going to sound like, oh, you make it sound so easy. You get to 10 million in revenues, which by the way, I know is not easy. But if you get to 10 million revenues, there's a whole other world of non-VC financing available to you, including private equity. So you just sort of have to get through that beginning part, which I know is hard and it takes a long time. But there are other mechanisms that are not VC that you can continue to use. And by the way, the best thing to do in terms of like not wanting to get involved in any of these other alternative financing areas is get to profitability. Then you control your own company and you control your own destiny.
Yeah. Profitability wins every time. I did want to ask a question about, and because we're almost at time, somebody asked, how do you get in front of angel investors, especially without a warm introduction? Because I think as women, we don't know as many angel investors, right? Like there's all these sort of men's groups that they all invest together and they're throwing introductions every which way. And it seems like they can secure 15 million, on a single phone call. If you don't have those kind of relationships, how do you think about building them or connecting with those people?
I'm so glad you asked this. So I think in 2020, wrote a very long blog post about how to find angel investors, which literally goes through, it's like 4 pages long. But it basically goes through kind of looking at your network and all the different people that live in your network. Your dentist could be an angel investor, right? So you really have to cast a very wide net. I feel like I'm doing a plug. My website is www.redgiraffeadvisors.com.
I was going to ask you that question. So thank you for covering that.
And there is a post there on how to find angel investors. And we would be here for an hour if I read it to you, but you can find it there. And I kind of really go through how do you qualify them? How do you find them? How do you research them? Who is even an angel investor? How do you know if they are? So I think that's a good resource. I also have a blog post and a podcast episode on how to write great cold emails. One of my portfolio founders, her name is Neha Agrawal, is literally the best cold email writer I have ever met.
I love Neha.
Yeah, so she is the best cold email writer. She has gotten investors. She's gotten people to respond to her for all kinds of things based on her excellent cold emails. So I did a podcast episode with her and then turned it into a blog post as well. So you can also find that on my website. I think writing great cold emails really works. I respond to cold emails. I think not everybody does. But if you write a great one and you've really done your research and you know the person, how could they not be flattered that you actually took the time to figure out who they are and then write a thoughtful email? So that's my best advice.
About who they are, right?
Yeah.
That they want to do that work and they want to understand, and because then that shows that they're strategic and smart and how they're going to potentially utilize you and partner with you.
Exactly.
So I love that. Sapna, this is amazing advice. Everyone, go to her blog and you can actually find all of this more information, dig in, but also book with her. We are so lucky and you are so generous to give these founders your time. And she can talk, I'm sure, about a lot more than just angel investing, and obviously has so much expertise, whether it's in consumer or retail tech or basically everything in that field. So if you have questions and pain points, she is here. But Sapna, we are so grateful to have had you and so appreciate your time. And everyone, thank you for giving your time, and good luck. We know this is a crazy world. And ladies, angel invest because we need you. And there's so many opportunities now with SPVs where you can write smaller checks to start. My recommendation is just get started, start doing it, and you will learn along the way. But super excited to see so many women interested in this discussion too.
Thanks, Allie. This was great.
Thanks, everyone. Bye.